All right, so we are transitioning from Chapter 1 to Chapter 2. And you still have to think about increases and decreases, but we're going to translate those increases and decreases to debits and credits. Take a look at the rules at the top here. And these are described in your textbook, and I described them in class as well. Here are all your T accounts. Here are the transactions in English. We're going to make our debits and credits, and then we're going to look at our trial balance. Let's take a look at transaction 1. On April 2, Ron invested $60,000 in his business. The basic analysis is an asset goes up, and it's cash. An increase in an asset is made with a debit. So cash gets debited $60,000. Additionally, the capital increases, but for the capital account, an increase would be with a credit. So we credit the capital account for $60,000. If you look over on the right at the trial balance, we now show cash $60,000 and the capital account at $60,000. Transaction 2, the company purchased $3,000 of supplies on account. Supplies goes up. An increase in an asset is made with a debit. We're buying these on account. This is an account payable in the amount of $3,000. Notice that when a liability increases, we make a credit. Transaction 3, this one is a purchase of equipment for $7,000. Another asset going up. Assets go up with a debit. So debit equipment $7,000. Cash goes down $2,000, so we have to make a credit to cash. And accounts payable is going to go up by $5,000 because that's the amount we still owe on that equipment. All right, if you look at your trial balance, we now have cash of $58,000. It has gone down by $2,000. Supplies are $3,000, equipment $7,000, accounts payable now $8,000. Capital is $60,000, and our totals balance at the bottom. Now we're going to earn some revenue in transaction 4. We earned $12,000 of revenue. This is an increase in owner's equity. And an increase in owner's equity is with a credit. So credit the revenue $12,000. $4,000 was received in cash, so cash going up by $4,000. And we also have some accounts receivable going up by $8,000. So two assets going up, which balance the revenue being earned. Trial balance is still in balance. Transaction 6, James borrowed $10,000 from Bank of America. Cash is going up $10,000. And notes payable going up by $10,000. So an increase in an asset, increase in a liability. Transaction 7, we're going to pay some rent. Rent is an expense. Expenses always decrease owner's equity, and that is the reason that you're going to make a debit to rent expense. We paid it in cash. Cash is going down. Check your trial balance. Looks like we are in balance. Cash now has a balance of $69,500. We're going to pay some advertising expense as well, and again, that expense makes the owner's equity go down by $1,500. We're paying it in cash, $1,500. Trial balance still remains with totals at $90,000, but you'll see that rent expense now has a debit balance of $2,500, and cash has a debit balance of $68,000. And finally, we have some supplies here. We bought originally $3,000 of supplies, but when we count them, there are only $1,000 left. How much did we use up? We must have used up $2,000 of supplies, and we record supplies expense, debit side $2,000, credit your supplies $2,000, and notice that the ending balance on the supplies is correct at $1,000. All right, so a good rule to follow on these, and I've tried to follow it as I described each transaction. Focus on the increase or decrease in the account. then use your rules at the top of the screen to make your debit and credit. This will make you reliable at analyzing transactions correctly. All right, hope that helps. Thank you for watching.